And what's up, you guys? Welcome to the Mango Grove. My name is Krisha, and this is going to be Mango Treat number 2 from the Mango Seed Program. Now, this is an initiative to, well, include many of you who are not able to join us on this journey and give you guys a couple of key lessons that we usually target in our daily videos. I personally, I'm student 0 of the Mango Seed Program, and this has helped me so much. Now, I get it, there's a lot of content in here, about 35 to 40 hours, but like I had mentioned in the last video, that Sean designed it in a way to take a beginner trader to an advanced level. Okay, so while there is a lot, we'll be picking out things that I think many of you can grapple with. Now, in the first Mango Treat, I picked out the introduction to the Ichimoku Cloud because that is something that we use extensively in our daily videos. Now, if you did not catch that first treat, I suggest you go and do so because, well, this one is going to be related. So let's give it a drum roll, please. Drum roll. And today's treat is actually going to be once again from that Ichimoku module, but this time I'll be picking the Tenkin Explained. Now, Sean does a phenomenal job with this, so I suggest you sit back and enjoy.
Welcome back, guys. In the last section, we discussed the various components within the Ichimoku system. In the section prior to that, we gave you guys an introduction to the Ichimoku and a brief history on how the Ichimoku system came to be, where we discussed a fun little story on how Goichi Hosada spent 30 years developing the various components of the Ichimoku system. Now, in this section, we are going to be tackling one of those components, which is the Tenkin Sen. So, the easy way to go ahead and do this is to simply give you guys the formula and say, hey, this is how it's calculated. Let me show you how it looks on the chart. Here are your trade opportunities. Boom, bam, thank you, mango, right? But no. That's easy, but that's easy for me, right? And in a way, it is more so of a cop-out. We're not going to do that. What we're going to instead do is do it the mango way. We're going to start with an analogy, and hopefully, and I'm certain actually, that by the end of this section, you're going to have a very firm understanding of the Tenkin, regardless of the formula being shown to you or not. But I'm going to go ahead and show you guys the formula at the end of the section anyways. Alright, so let's go ahead and get started with our analogy. We're going to go ahead and switch on over to a blank slide, turn on our drawing tools right over here, and now let's pretend that you wake up one day and you have a sudden craving for fruit. And not just any fruit, you are craving mangoes. You haven't had mangoes in months. Now suddenly, you have a strong craving for mangoes. You just have to have some mangoes. And you're thinking to yourself, man, mangoes tend to be really expensive at this time of the year. Fortunately though, you know a guy, you know a particular mango merchant that you can go to and you can probably get a better deal. But at the same time, you know that it's not polite to just go and ask for a low price. You better go up to him and chat him up a little bit, right? So you go down over to your friendly neighborhood mango merchant and you chat him up a little bit. You say, hey man, how's it going? It's been a while since I've seen you. How's business going? And he replies with, well, business is good, but it's quite erratic. And you reply with, what do you mean? And he replies with, well, prices are high one day, prices are low another day. It's really all over the place. Anyways, how may I help you? And you reply with, well, it's funny that you mentioned that because I'm actually craving some mangoes and I'm looking for a good price. I was hoping you could help me out with that. And he says, well, you've actually shown up on the wrong day, man. Today, prices are on the higher end, higher side of things. Perhaps you can come back tomorrow or day after and prices will be better. And you are like, nah, man, I'm craving mangoes today. I'm really busy. I'm not even sure if I'll be able to make it tomorrow or if I'll have the craving tomorrow. How about you do something else for me? How about you give me the average price of the mango over the past, let's say, 2 or 3 weeks? Alright, so let's stop over here for a second. What's the scenario thus far? You are a buyer in the market looking to buy some mangoes, there's a merchant available and he's telling you that prices tend to fluctuate. So you're like, okay, you know what? I'm willing to be a buyer at the average price over the past week or so, right? Couple of weeks. And this is not a bad idea at all, right? And the merchant should find it pretty reasonable as well. So let's go ahead and just put down average right over here, okay, as your first strategy. You are willing to be a buyer at the average price of the mangoes over the past couple of weeks. And the merchant says, hey, that's actually a pretty good idea. But listen, man, I'm just a simple mango sales guy over here with a cart full of mangoes. I don't keep track of the prices every single day. I can't come up with an average price. And you're like, that is a problem. If we don't have the prices for every single day over the past like 30 days or so, there's no way you can come up with the average price of a mango for the past month, right? So the strategy to buy at the average price is out. Okay, so we can no longer use this strategy. You need to come up with a new way to get a fair price. And how do you do that? So you're thinking there, right? And you're a pretty smart guy, and you come up with a possible solution right off the bat. And you ask the merchant, how about this, man? Do you at least remember the highest price of the mango over the past 30 days and the lowest price of the mango over the past 30 days? Okay, so let me go ahead and write that down now. Now you're asking for the highest price, okay, of the mango and the lowest price of the mango. And he's like, yeah, I can probably remember that. And he's just thinking there for a quick second. He's like, yeah, so the highest price this month has been around $75 and the lowest price has been around $25. You're like, okay, cool. So how about we do this, man? How about you meet me midway between the highest price and the lowest price? And he says, that could actually work. What would that price come up to, if I may ask? And you're like, hey, that's actually pretty simple. All we have to do is take both of these prices over here, add it, and divide by 2. It's a simple formula from high school math where we were trying to calculate the midpoint of a line segment, if you do remember, guys, right? So again, that's all we're doing over here. The mid price, okay, of the high and the low is simply 75 plus 25 divided by 2, right? So what would that give us? 75 plus 25 gives us $100, right? Divided by 2 gives us $50. And there we have it, okay? That's our midpoint between 75 and 25. So the merchant says, $50, that's a fair price for me too. I'm willing to sell to you at that price. And you as a buyer, you're like, yeah, this is the average price between the high and the low over the past 30 days, right? So in a volatile market like the mango market, where prices are fluctuating super high one day, super low one day, you and the merchant have come to a conclusion, a agreement that the mid between the volatility high and the volatility low is a fair price to agree to exchange goods, right? Where he's accepting your $50 and you are accepting the mangoes. And that's essentially what the Tenkin calculates as well, right? All we need are 3 inputs. We already have 2 listed over here on the slides, a high and a low. And the third input is something we mentioned in our story very, very subtly. Remember, you ask the merchant, tell me what the highest price was over the past 30 days and the lowest price was over the past 30 days. So you are looking at the volatile high and the volatile low only over a certain time period, right? So all we need is the high, the low, and the time period. In this example, we took 30 days, right? And that was your Tenkin being calculated for that data point on that day when you showed up to the merchant, right? He gave you the Tenkin data point for that single day. So at that day, the Tenkin price of the mango was coming up to $50, considering that you were looking at the last 30 days. Now, this is where things get really, really interesting.
And there you have it, a well-articulated analogy on the Ichimoku Tenkin. And this is honestly what I really like about the Mango Seed program. It's that it is full of these kind of analogies that really makes it fun and puts things into perspective all at once. And Sean does such an amazing job with them. So if you enjoyed this one, make sure to hit that bell icon, that way you'll be the first to be notified on the next mango treat. With this, guys, trade safely, trade stress-free, trade the mango way, trade the easy way. Ciao.